You've seen the headlines, right? These massive corporations, the super wealthy, and somehow they pay little to no tax, while the rest of us are, well, paying our share. So how do they do it? Is it all illegal? Actually, a lot of the time it's perfectly legal. It's thanks to a really complex global system and one of their absolute favorite tools, the tax haven. So how does the secret playbook actually work? Let's dive in and break it down. So over the next few minutes, we're going to unlock the secrets of tax havens. We'll start with what they even are. Then we'll get into the really juicy stuff, the playbook of loopholes they use. We'll also figure out why these places even exist, take a quick world tour of the financial hotspots, and finally, look at the real global impact of this whole shadow economy. Okay, first things first, what exactly are we talking about here? Let's get the name right. It's a tax haven, H-A-V-E-N, like a safe harbor or a refuge for money. Although I'm sure for the people using them, it absolutely feels like tax heaven. Now here's the thing. There isn't one single official definition that everyone agrees on, which is kind of part of the problem. But for our purposes, a tax haven is basically a country that offers foreign companies and individuals a sweet deal, almost no tax, and a place that's politically and economically pretty stable. Think of it like a recipe. You need 3 key ingredients. First, and this is the big one, you need super low or even zero taxes. We're talking corporate profits, income, you name it. Second, you need ironclad privacy laws, total secrecy. And third, you need stability, because no one's going to park their money in a place that's politically shaky. All right, now we're getting to the heart of it. How does this all actually work? It's not like people are hiding suitcases of cash. No, it's way more sophisticated. It's a whole playbook of incredibly clever, complicated, and yeah, often totally legal tricks to make those huge tax bills just disappear. The first play in the book is the Controlled Foreign Corporation, or CFC. This is pretty much just a company that you set up in a tax haven. A lot of the time, it's what they call a shell company. I mean, it doesn't have a real office or any employees. It's just an address, a legal entity on paper that exists for one reason: to hold money. Apple was an absolute master of this strategy. They set up a shell company in Ireland, but they engineered it brilliantly. See, at the time, the US taxed companies based on where they were registered, but Ireland taxed them based on where they were managed. So, by registering in Ireland but managing the company from the US, their subsidiary fell into this legal black hole where, technically, it didn't owe corporate tax in either country. It was a perfect and unbelievably profitable loophole. All right, the next trick is called transfer pricing. This one is all about moving profits around inside one big company to make sure the money ends up in whatever country has the lowest taxes. To make this really clear, let's invent a company. Let's call it Wee Wee Shoes. So let's say Wee Wee Shoes, the US branch, makes $1 million in profit. Simple enough. In the US, with a 21% corporate tax rate, their tax bill should be a nice, round $210,000. Straightforward, right? Ah, but this is where the magic happens. Instead of just paying that, Wee Wee Shoes opens up a shell company in the Cayman Islands where the corporate tax rate is a beautiful 0%. Then the U.S. company pays its own Cayman branch a massive $900,000 royalty fee for using the brand's logo and designs. All of a sudden, their profit on paper in the U.S. is just $100,000. And their tax bill? It shrinks all the way down to just $21,000. So you're probably asking, where'd the other $900,000 go? Well, it's sitting pretty in the Cayman Islands, completely untaxed. And here's the final move to complete the trick, getting that cash back to the U.S. The Cayman branch simply gives a loan of that $900,000 back to the U.S. parent company. Since loans aren't income, they're not taxed. The money comes right back home, clean. They can even set the terms to something ridiculous, like a 100-year repayment period. It's wild. And that, of course, brings us to what is possibly the most famously named tax strategy of all time, the double Irish with a Dutch sandwich. I know, it sounds like something you'd order at a pub, but it was a seriously complex strategy that giants like Google and Apple used to save literally billions of dollars. This one really shows you just how intricate these schemes can get. So here's the basic money trail. Profits would move to an Irish company. But to avoid Irish taxes, that money was immediately routed through a shell company in the Netherlands, that's your Dutch sandwich part, which took advantage of an EU law allowing tax-free transfers between member states. From there, the money went to a second Irish company that was secretly managed from, you guessed it, a tax haven, Bermuda. This legal trick allowed the profits to finally land in Bermuda, untouched by taxes. It was a masterpiece of avoidance. But intense international pressure finally forced Ireland to close this loophole down for good by 2020. So this all begs a pretty obvious question, right? Why would any country choose to be a tax haven? I mean, if they're not collecting taxes on all this money, what's in it for them? The answer really comes down to scale. For a small country, maybe one with very few natural resources, attracting all this foreign money is an incredibly powerful economic strategy. What a giant corporation thinks of as a tiny little registration fee can be a massive boost to a small nation's entire economy. Just to put that into perspective for you, a single $5 million fee from one company is equal to 0.1% of the entire GDP for a country like the Cayman Islands. So imagine you get just 10 companies to set up shop. You've just boosted your GDP by a full percentage point from fees alone. That is a huge incentive. Now, it's also important to understand that not all tax havens are the same. They're all over the world, and they kind of specialize in different things. So let's take a real quick tour. You've got your classic zero-tax spots like the Cayman Islands or Bermuda. Then you have low-tax countries, not zero, but way lower than elsewhere, like Singapore or Luxembourg. Others, like Switzerland, have historically been all about that extreme financial secrecy. And then you have countries that offer special tax breaks just for specific industries, like Ireland for tech companies or the Netherlands for intellectual property. So we've seen the how and the why, but what does this all actually mean for the rest of us? Well, the global impact is pretty staggering. Because while all these strategies are great for a select few, they come at a huge cost to the rest of the world. So why should you care? Well, when billions or even trillions in corporate profits go untaxed, it means there's less money for public services. We're talking schools, roads, hospitals, and to make up for that lost revenue, governments often have to raise taxes on, you got it, the middle class. This whole system just widens the gap between the rich and poor, and as big scandals like the Panama Papers showed us, all that secrecy can also be a perfect cover for illegal activity like money laundering. The good news is there is a real global pushback happening. We already saw how the EU forced Ireland to shut down that double Irish loophole, and in 2021, something pretty historic happened. Over 130 countries agreed in principle to a global minimum corporate tax rate of 15%. This is a huge step designed to stop what they call the race to the bottom, where countries are just constantly competing to offer a lower and lower tax rate. But the fight is definitely far from over. With literally trillions of dollars on the line and the playbook of loopholes constantly changing and evolving, we're really left with a massive question. Can a set of global rules ever truly be enough to level the playing field for good?